And transactions are actually the business activities that get recorded that make up the account balances that are in the general ledger and the trial balance, which are the basis of the formation of the financial statements we just talked about. Business activity is all about transaction. A transaction is any event that has a financial impact on the business and can be measured reliably. But not all events qualify as transactions. For example, a transaction for a retail store would be when a customer buys a product or store purchases inventory. Transactions provide objective information about the financial impact on a company. Every transaction has two sides. Essentially, you give something and you receive something. In accounting, we always record both sides of a transaction, and we must be able to measure the financial impact of the event on the business before recording it as a transaction. An example of transaction is when a company sells a product to a customer and receives cash. The company is giving a product and receiving cash. Another example would be when a company pays for advertising. The company is giving cash and receiving advertising. And so you can see there's this reciprocity in the relationship between the parties to the transaction. And what we're trying to do with accounting is to record the essence of that transaction so that when it rolls into the financial statement, in conformity with generally accepted accounting principles, it reflects accurately and reliably reflects the impact of that relationship on the results of operations. The second thing we want to talk about today is to define an account and list and differentiate between different types of accounts. The accounting equation expresses the basic relationships of accounting. And as you recall from our last class, we said that the accounting equation is assets equal liabilities plus stockholders' equity. For each asset, each liability, and each element of stockholders' equity, we use a record called the account. An account is the record of all the charges or changes in a particular asset, liability, or shareholder or stockholders' equity during a period. The account is the basic summary device in accounting. Assets are economic resources that provide a future benefit for a business. You should recall this from our last session. Most firms use the following asset accounts: cash, money and any medium of exchange, including bank account balances, paper currency, coins, certificate of deposit, and checks. Accounts receivable. A company sells its goods and services and receives a promise for future collection of cash. The agreement to allow customers to pay in the future is informal and usually for a short period of time. The accounts receivable account holds these amounts. And the level of formality around an accounts receivable really varies by company. In some cases, there are purchase orders and other documents that are generated which contractually bind buyers and sellers to the terms and conditions, including how long an accounts receivable can be outstanding without being considered past due. Notes receivable is another asset, and a notes receivable is when a company may receive a note receivable from a customer who signed the note promising to pay. A notes receivable is similar to an accounts receivable, but a notes receivable is more binding because the customer signed the accounts. Notes receivable usually specify an interest rate. And then we have inventory, which I think everyone can relate to. Often a company's most important asset is its inventory, the products it sells to customers. Other titles for this account include merchandise and merchandise inventory. And then lastly, we have an account prepaid expenses. Companies pay certain expenses in advance, such as insurance and rent. A prepaid expense is an asset because the payment provides a future benefit for the company. So, for instance, if I paid 12 months of my rent during the first month of my rent period, I have a prepaid asset. I paid ahead the rent for the next 12 months, and so I'm able to capitalize that or treat that as an asset. Other assets that are non-current, or we called long-term assets in our last session, are items like land. The land account shows the cost of a land a company uses in its operations. So if a company buys land and builds a factory, or buys a factory, There's a portion of that purchase price that is allocated to land, which is non-depreciable, and a portion which is allocated to property and plant, which becomes depreciable. Buildings. These are the cost of office buildings, manufacturing plants, and the like, and they appear in the buildings asset account. And then equipment, furniture, and fixtures. These asset accounts include such items as computer, office furniture, and store shelving. The assets land, buildings, equipment, and furniture and fixtures are examples of those assets referred to earlier as property, plant, and equipment. Note that even though they are reported on the balance sheet in one amount, they are tracked in separate accounts. So recall that a liability is a debt, so it's something that the company is going to have to pay out and satisfy at some point in time in the future. It may be in the next 12 months, it may be sometime after the next 12 months. This period of time gets us to the treatment of either current or non-current. So the most common types of liability includes accounts payable. They're the opposite of accounts receivable. Accounts payable is a company's promise to pay a debt arising from a credit purchase of inventory or from a utility bill appears in the accounts payable account. Notes payable. That's the opposite of a notes receivable. The notes payable account includes the amounts a company must pay because it signed notes promising to pay a future amount. Notes payable, like notes receivable, also carry interest. And then accrued liabilities. And so an accrued liability is a liability for an expense you have not yet paid. Interest payment and salary repayment payable are accrued liability accounts for most companies. Income tax payable is another accrued liability. And then we get to the stockholders' equity section. The owner's claims to the assets of a corporation are called stockholders' equity, shareholders' equity, or simply owner's equity. A corporation uses common stock, retained earnings, and dividends account to record changes in the company's stockholders' equity. Revenues increase stockholders' equity and expenses decrease stockholders' equity. And you recall that those increases and decreases as a result of net income are reflected in the retained earnings account. So different types of stockholder equity accounts include common stock, and this account shows the owner's investment in the corporation. The corporation receives cash and issues common stock to its stockholders. The company's common stock is the most basic element of equity. All corporations have common stock. Retained earnings. This account shows the cumulative net income earned by a corporation over its lifetime, minus its cumulative net losses and dividends. Dividends. After profitable operations, the board of directors of a corporation may or may not declare and pay a cash dividend. Dividends are optional. They are decided by the board of directors. The corporation may keep a separate account titled dividends, which indicates a decrease in retained earnings. They're essentially treated as a return of capital to the shareholders. We also talked about revenue. The increase in shareholders' equity from delivering goods or services to customers is called revenue. So the company uses as many revenue accounts as needed. Companies that sell merchandise use a sales revenue account for revenue earned by selling its products. Companies that provide services have a service revenue account for the revenue it earns by providing services to customers. A business that loans money to an outsider needs an interest revenue account to record the revenue that they receive as a result of the borrower paying the company interest. If the company rents a building to a tenant, the business needs a rent revenue account. So you can see that we can set up as many revenue accounts as we need in order to, again, reflect what the essence of the underlying activity is. Expenses are another account that impact the stockholders' equity. Expenses are the cost of operating a business. Expenses decrease stockholders' equity, the opposite effect of revenues. A business needs a separate account for each type of expense, very much like revenues. So expense accounts might include something like cost of goods sold, salary expense, rent expense, advertising expense, insurance expense, utilities expense, and income tax expense. Businesses strive, of course, to minimize expenses and thereby maximize net income. So our next topic is going to understand what the impact of business transactions are on the accounting equation, which by now you should have memorized and recall that it's asset equal liabilities plus stockholders' equity. And so to understand this, we will use the events that are depicted in exercise 2-16A. We'll start with the accounting equation and then increase or decrease the appropriate accounts. Notice that as each transaction is recorded, the accounting equation stays in balance by making sure that each transaction is balanced. Each side of the equation will be changed in the same direction, or the same side of the equation will be changed in opposite directions. So our example is that Bob Morin opened a medical practice specializing in surgery. During the first month of operation, August, the business, titled Bob Morin Professional Corporation PC, experienced the following events. On August 6, Morin invested $39,000 in the business, which in turn issued its common stock to him. This would increase cash with a debit, an asset, and increase common stock, an equity account, with a credit. So you can see that as far as the accounting equation goes, we increased assets, that is, the company received cash, and we increased stockholders' equity, each by the same amount. And so that equation stays in balance. On August 9th, the business paid cash for land costing $29,000. Morin plans to build an office building on the land. This transaction increases one asset, land, and decreases another, cash. So we decrease cash with a credit, because it's an asset, and we increase land with a debit for the same amount, because it's an asset, and because we have an increase on the asset side of the equation and a decrease by the same amount on the asset side of the equation, the accounting equation is still in balance. On August 12th, the business purchased medical supplies for $1,700 on account. That means they created an accounts receivable on the vendor side and created an accounts payable on their side. This transaction increases supplies, an asset, and increases a liability, accounts payable. So we debit the supplies account because now we have $1,700 worth of supplies on hand to use for later, and we credit our accounts payable account because now we are going to have to pay that vendor eventually. And so you can see that we are still in balance with respect to the accounting equation. On August 15th, Bob Morin officially opened for business. Although an important event, this is not a financial transaction, so it has no impact on the accounting equation. And so from August 15th through the 31st, Morin treated patients and earned service revenue of $7,600, receiving cash for half the revenue earned and allowing some patients to pay in the future. Revenue would increase and two assets would also increase. Cash is received, and the amount that we received in the future is an accounts receivable. So you can see that revenue increased by $7,600, and that's an income statement account. The offset to that $7,600 was an increase to cash as well as an increase to accounts receivable, which is an asset, which is a claim to a payment later on from these clients. So, and with that, we are assuming no expenses, and so the revenue in this example went right into retained earnings. So our accounting equation is still in balance. And additionally, between August 15th and August 31st, the business paid cash expenses of employee salaries of $1,300, office rent of $700, and utilities of $500. And we assume that these are all paid in cash based on the wording. And so because of that, then we see that cash decreases, our expenses increase as well, but because they are an increase in expenses, they go to reducing retained earnings. So we've reduced cash and we've reduced retained earnings, and we see then again, as the rest of our examples show, that the accounting equation is still in balance. On August 31st, the business sold supplies to another physician for a cost of $700. So in this example, we can see that cash went up because we received cash of $700, but our supplies inventory went down. So we had one asset increase, we had another asset decrease by the same amount, and so again our accounting equation stays in balance. And then on August 31st, the business borrowed $12,000, signing the notes payable to the bank. By borrowing $12,000, we see that the cash balance increased, and then on the other side of the equation, because we signed a notes payable to the bank, we now have a liability, or notes payable of $12,000, which increased, keeping our accounting equation in balance. On August 31st, the business paid $800 on account. The company pays cash to satisfy the liability from earlier in the month. In that case, cash went down, so we credit cash, we reduce our cash, and our accounts payable also went down, and when accounts payable, liabilities decrease via credits. Liabilities decrease via debits. So we had a credit to cash because it went down, we have a debit to liabilities because it went down, and so the accounting, the left-hand side of the asset equation reduced, and the right-hand side of the equation, the liabilities portion reduced. It's now the end of the month and time to determine the ending totals for the month. As you can see, the four asset accounts, cash, land, accounts receivable, and supplies, total $57,000. The two liability accounts, accounts payable and notes payable, equal $12,900, which is added to the common stock account of $39,000 and retained earnings of $5,100, so that liabilities and equity total $57,000. And so we see that our assets equal our liabilities plus our stockholders' equity. After completing the analysis, answer these questions about the business. How much are total assets? And we saw that they're $57,000 earlier. How much does the business expect to collect from patients? We expect to collect $3,800, which is the balance of accounts receivable. How much does the business owe in total? Well, in total, the business owes the amount recorded to the accounts payable account and the notes payable account. And so when we add those two up, we should get $12,900. And then, how much of the assets does Morin really own? So to get to that, we have assets minus our liabilities, or the balance of the two stockholders' equity accounts, which is common stock and retained earnings, which we get $44,100. And so that's essentially how transactions work through the balance sheet. We left the income statement out of this, and we just used the retained earnings account to catch and hold the revenue and expense accounts. But in essence, we would have an income statement where these revenue and expenses would be recorded. And then when we close out the income statement, we would just, and when we close it out, we get to net income, we would just move net income over into retained earnings. So it's essentially the same process. Then finally, how much net income or net loss did the business experience during its first month of operations? And we say that net income is revenues minus expenses. Revenues totaled $7,600. From that, we have to deduct the expenses, which were the sum of the $1,300 plus the $700 plus the $500, or $2,500, resulting in a net income of $5,100. So our next objective is to analyze the impact of business transactions on accounts. All business transactions include two parts, and you recall this from earlier. We give something and we receive something. And you can see in each of the examples that we just talked about, we were selling services and receiving cash, or receiving a promise to pay. We were borrowing and receiving a cash, and executing a promise to pay the bank back through a notes payable. We were receiving supplies and promising to pay an accounts payable later. We were eventually paying that accounts payable, so we were giving up cash, and we were receiving forgiveness of that accounts payable. So accounting is therefore based on a double entry system, which records the dual effects on the entity. Each transaction affects at least two accounts. An account can be represented by the letter T. We call them T accounts, and this is a very basic fundamental way of visualizing how transactions flow through different accounts. The vertical line in the letter divides the account into its two sides, left and right, or debit and credit. The account line appears at the top of the T. The left side of each account is called the debit side, and the right side is called the credit side. Often students are confused by the words debit and credit. Just remember that debit means left side and credit means right side. Every transaction involves both a debit and a credit. The type of account determines how we record increases and decreases. The rules of debit and credit are shown above. Increases in assets are recorded on the left or the debit side of the account. Decreases in assets are recorded on the right or credit side. You receive cash and debit the cash account. You pay cash and credit the cash account. Conversely, increases in liabilities and stockholders' equity are recorded by credits. Stockholders' equity also includes the two categories of income statement accounts, revenue and expenses. Revenues are increases in stockholders' equity that result from delivering goods or services to customer. Expenses are decreases in stockholders' equity due to the cost of operating the business. Therefore, the accounting equation may be expanded. Revenues minus expenses equals net income, which increases stockholders' equity. If expenses exceed revenues, there's a net loss, which decreases stockholders' equity. So we can now express the final form of the rules of debit and credit as shown above. You should not proceed until you have learned these rules. For example, you must remember that a debit increases an asset account. A credit decreases an asset account. Liabilities and stockholders' equity are the opposite. A credit increases a liability or stockholders' equity account. A debit decreases a liability or a stockholders' equity account. And it's key to get these right and to be able to think of them in terms of, is it an asset account, a liability account, or a stockholders' equity account? And then am I increasing it or decreasing it? And depending on which side of the equation it's on, whether I'm increasing it or decreasing it depends on whether I use a debit or a credit. And so this is one of the most fundamental parts of accounting. So it really, now's the time to get this right, because we'll have plenty of practice, and if this is confusing to you, it's going to do nothing but complicate the rest of the semester for you. So we won't get into it here, but there are some items that talk when we talk about contra accounts that work a little differently, but there are not very many of those, and so I'd really just focus right now on assets increasing with debits, decreasing with credits, and then liability and stockholders' equity decreasing with debits and increasing with credits, or the opposite of how assets work. So next we want to talk about how we journalize and post transactions in the books. Accountants use a chronological record of transactions called a journal, also known as a book of original entry. The journalizing process follows 3 steps. Specify each account affected by the transaction and classify each account by type. Is it an asset, a liability, a stockholders' equity account, a revenue or expense account? Determine whether each account is increased or decreased by the transaction. Use the rules we looked at earlier of debit and credit to increase or decrease each account. Remember that the amount of the debits must always equal the amount of the credits. Record the transactions in the journal, including a brief explanation, and this is called a journal entry. The debit side is entered on the left margin, and the credit side is indented to the right. Now, in a lot of automated accounting systems, there's no longer this need to write a journal entry this way. They're entered into a program or into a third-party tool that is then uploaded to your software database, or they're entered directly into the database, and you don't have this indentation and other some of these other nuances, but this is a good way to think about this, because you may very easily be going into a company that doesn't have a more sophisticated accounting software system. So let's apply the steps to journalize a transaction in which a company issues stock for $50,000 cash on April 2nd. So essentially what we're saying is that the company issued stock to a stockholder, and in return for that stock, the stockholder paid the company $50,000 in cash. So both the cash and common stock increase under that scenario. When cash increases, we debit it because it's an asset. When common stock increases, we increase that with a credit, and that way we're still in balance, and the essence of that transaction is accurately reflected in the journal, and this is what a journal entry would look like under that scenario. And you can see there's a very brief minor description underneath the debit and credit rows that say issued common stock. So we say the journal is a chronological record of all company transactions listed by date, but the journal does not indicate how much cash or accounts receivable the business has. The ledger is a grouping of all of the T accounts with their balances. For example, the balance of the cash T account shows how much cash the business has. The balance of the accounts receivable account shows the amount due from customers. The accounts payable balance shows how much the business owes suppliers on open account, and so on. In the phrase keeping the books, books refers to the journals as well as the accounts in the journal. In most accounting systems, the ledger is computerized. The figure above shows how asset, liability, and stockholders' equity accounts are grouped in the ledger. The flow of accounting data is as follows. A transaction occurs and then is analyzed to see its effect on the company's account. Next, a journal entry is made to record the transaction. Periodically, amounts from the journal entry are posted to the ledger to determine the account balances. And this is a portion of, we'll talk later about this idea of an accounting cycle. So this flow is a portion of that accounting cycle. So now we want to talk about how to construct and use what we call a trial balance. A trial balance lists all of their accounts with their balances, assets first, then liabilities, and then stockholders' equity. The trial balance summarizes all of the account balances for the financial statements and shows whether total debits equal total credits. A trial balance may be taken at any time, but the most common time is at the end of the period. So we may have a monthly closing process where we will generate a trial balance. We may have a quarterly closing process that we generate a trial balance, and we'll generally, most definitely have an annual closing process where we generate a trial balance. And from that trial balance, then we prepare our financial statements. Accounting errors can occur even in computerized systems. Input data may be input wrong, or they may be entered twice or not at all. A debit may be entered as a credit and vice versa. You can detect the reasons behind many out-of-balance conditions by computing the difference between total debits and total credits on the trial balance. Then perform one or more of the following actions. Search the records for a missing account. Trace each account back and forth from the journal to the general ledger. Divide the out-of-balance amount by 2. A debit treated as a credit or vice versa doubles the amount of the error. Divide the out-of-balance amount by 9. If the result is an integer, that is no decimals, the error may be a transposition, right? Where the accounts would be out of balance by something that's evenly divisible by 9. So there are several ways that if a trial balance or is out of balance, how to find that difference. Sometimes this can be very difficult, particularly if you have thousands and thousands of transactions each month, and at the end of the month when you go to balance your trial balance, you find that you're out of balance by $500 when $500 million worth of transactions may have gone through your accounts. So, as you know, the ledger contains the accounts grouped under these headings. Balance sheet accounts, we said, were assets, liabilities, and stockholders' equity, and income statement accounts, which are revenue and expenses. Organizations use a chart of accounts to list all of their accounts and account numbers. Account numbers usually have 2 or more digits. Asset account numbers may begin with 1, liabilities may begin with 2, stockholders' equity may begin with 3, revenues with a 4, and expenses with a 5. And all we're saying there is that there's some intelligent way of numbering those accounts so that perhaps I know that if I'm looking at any account that starts with a 1, even it could have 10 numbers after it, but if it starts with a 1, then I know it's an asset account. Perhaps if it starts with a 1-1, and then some numbers, I know it's a current asset account, and a 1-2 and so on is a long-term or non-current asset account, and so on with liabilities and stockholders and revenue and expenses. We're just trying to build some intelligence into the numbering convention in the chart of accounts. And as an aside, this also helps us a lot when we're developing the reports that are generated off of these account balances, because in defining what accounts go in certain rows on your financial statements, you can range those accounts so that then you could say, so all assets, all current assets, or all cash accounts equal any cash account that begins with a 10 XXX through a 10999, and we can do that same with liabilities, stockholders' equity, and revenue and expenses. It just gives us some efficiency in building reports if we have some intelligence to the way we define and number our chart of accounts. And then finally, we want to talk about an account's balance or an account's normal balance. And it is true that each account has a normal balance that could be a debit or a credit. And so we can see for assets, their normal balances are debits. Now, that's not to say that you can't have an asset that has a credit balance. You can have a cash account that would normally have a debit balance that has a credit balance, which generally would say that the cash is overdrawn, right? We've taken more out of it than we put into it. So the normal balance of assets is on the debit side, so assets are debit balance accounts. Conversely, liabilities and stockholders' equity usually have a credit balance, so these are credit balance accounts. As explained earlier, stockholders' equity usually contains several accounts. And so that's Chapter 2. Again, I encourage you, as I do on each of these sessions, that you read the book closely and then perhaps come and flip back through this presentation if something isn't clear, to see if that helps. And then if that still is an unclear concept, don't hesitate to send the instructor an email and request some clarification on it. And then I would encourage you, as soon after reading that, if you would go into the practical module and complete the learning exercise for that chapter to help reinforce what you've just read. I'm looking forward to talking with you again later on Chapter 3. Thank you.